Hello, friends, welcome back. And today's learning is about the topic banking. So, let's begin with the same. So, when we talk about banking, there is one wonderful, beautiful phenomenon, which is the capacity, the unique capacity of bank, that is the power of creating credit. And this systematic approach, this phenomenon is asked for 6 marks in the boards also. At times, some segment is asked for 3 to 4 marks, wherein you can talk about some particular assumptions or the process or the mechanism or numerical based on that or on the table. So, learning credit creation would be a blessing to all the students, right? So, let's begin. What do we mean by this credit creation? So, as the name suggests, that banks have a unique capacity to create credit. How do they do it? Before going deep into it, let's talk about what do the banks do. Banks are such financial institutions who are approached by both, we talked about the two sectors, the households and the firms, generally so. So, households as well as the firms. Right. Households, they save and give to bank, and firms borrow from bank. Right. So it's not mandatory that only this segment, whosoever saves gives to bank, and whosoever invests or does some credit creation or some capital formation, so they borrow. Those who are in need of borrowing borrow from banks. Those who have some surplus funds, they save. But general categorization is this. Right. So, how and what the banks do? Because households are sacrificing their money and savings, so bank gives them some return, right? And the firms who borrow from banks, because banks are helping them, so the firms do give the interest to them, right? Say bank gives 5% interest to the households and charges 8% interest from the firms. So the difference of 3% is how the banks survive and they take their operating costs. Right. So, in this process only, where the money of somebody else is used by somebody else through some certain mechanism, the banks are able to create credit. And this particular phenomenon, where simply bank are diverting somebody's money to somebody, right? In that way they are satisfying both the categories. So this is called credit creation. And let's understand the basic details of credit creation. For this I have taken one table to make you the things clear, right? So when we talk about credit creation process, so this process first of all assumes certain things, like for the sake of simplicity only, for making this a simple process of learning, we assume that there is one bank in the economy. There is no cash transaction, means every transaction, monetary transaction, has to be routed via banks, right? And there has to be certain initial deposit with the bank. So the first deposit which is received by any bank is called initial deposit, and we call this as primary deposit also. So the primary deposit and the initial deposit, they are synonyms, right? So these are assumptions. In this assumption only, we do talk about certain technical assumptions, like here in this very case, the initial deposits or the primary deposits are rupees 1000, right? And the fourth assumption is that the cash reserve ratio, or we would simply say reserve ratio. Different countries talk about different types of reserve. Reserve ratio as defined is, it's fictitious it may vary, and it actually varies depending upon the circumstances. RBI in India keeps on giving the new stipulations all the time, right? So reserve ratio is assumed to be 20%. So let's understand how this phenomenon works. So for working this, we begin with the very first round, that say a depositor A has deposited 1000 rupees. So now the bank knows that whatever money has been deposited, of course the same money is not required to be there in liquidity with the bank, right? And it's just lying idle. So better and the best utilization is to give it or lend it further for somebody else's uses, and hence get some money in return from that borrower, right? So considering that 20%, 80% extra money or excess money, here it's called excess reserve, 80% of 1000 becomes 800. So that is lent out to some other person who is in need of money. So these are the loans given, and 20%, as is the mandate by the authorities, right? In India, the authorities are the apex institution of banking, that is RBI. Here it is assumed it is 20%. So 20% of 1000, that is 200 rupees, are still kept as reserve with the bank. Reserve means that's not to be used, that has to be there either with the bank. Here cash reserves are there, so these would be given to RBI. Right. So the excess money is 800, which is given in market to some other person. Right. So as we have already assumed that there is one bank, so that person who has borrowed money would be fulfilling his need, and that money again goes back to bank. Maybe he wanted this for some construction material or for some other utilities, goods and services, for education, for whatever. That money, whosoever is the recipient, that recipient would be putting that money into the bank again. So that money has again come to banking system through another person called B. Now for B it is the primary deposit, but for the bank this 800 has become the secondary deposit. Right. Now again, the same systematic approach, the 20% of this deposit would be given out and lent out. So this goes in the market and this remains with the bank. Which is going out in the market increases the flow of money, the circular flow of money, and hence helps in the growth of money, because that is fulfilling the needs of other people. On a very similar note, 20% of 800 is 160, and hence 160 is again back in the bank, right? Again, because the only channel of distribution is the banking system, so this 640 is borrowed by somebody for some other need, and again this 640 returns back to the bank, and now these are the primary deposits of person C. Now 640, following the same systematic approach, the 20% is retained by the bank, and the rest 80% of 640 would be lent out to some other person. So this chain keeps on going and going and going. So these are the rounds which do happen. And when would this round cease to happen anymore? When the money which is in reserves becomes exactly equal to how and where from we began. We began with 1000 rupees, and the bank has again got systematically, gradually, slowly 1000 back. So there is no money in the economy to move any further, and hence all the deposits now are being created. So the primary deposit here is 1000, and the derivative deposits are rupees 4000. Right. We do have some numerical relationships also for finding how much is the credit created here in this economy. So credit creation capacity is nothing but the inverse of the reserve ratios right? So into the initial deposits. Right. So credit creation, how much is credit creation happening? The reserve is, the reserve ratio is 20%. So 1 by 20 into 100 into initial deposits are 1000. So 0 goes with 0 and this is 5. And hence the total deposit, the credit creation here is, the total deposits are, I would, instead of writing the credit creation, I would write the total deposits here are 5,000. Out of these 5,000, 1,000 had been the primary deposit. See here, and extra 4,000 has been created by the bank with its unique capacity of credit creation, right? So this is the primary deposit, or we call it initial deposits, right? And the 4,000 component is called the derivative deposits or the secondary deposits. So these are the other alternative names which are there, right? And here we say what is the credit creation. So credit creation is nothing but the inverse of the reserve ratio, and reserve ratio is 1 by 20%. And here 20% is 100 divided by 20 is equal to 5. It means the total money created is 5 times the initial deposits. So we have, as we have created, as we have found this 5,000 here, so we have another example like total deposits is equal to, you can have this formula, the total deposits is equal to the credit creation capacity multiplied by initial deposits, and credit creation is the 5 times and initial deposits are 1000. It is one and the same as has been given before. So this 5,000 now is created in the economy. How? By the unique capacity of bank, because banks are more reliable. People, those who have surplus money, to give them the money, and people who need money ask money from them. So because of this reliability factor, they help in increasing the flow of money in the economy. Right. So these calculations of 5 times 5,000, this total deposit, these are very, very essential from paper's perspective. If you want to score all 6 marks on this very question, you need to give, because this table, for sure, you can have 10%. This is all your assumption. You can have 10%, you can have 100 rupees. So you can begin with any sort of figures. That's your own good wish. But the point is you need to explain this working. So whenever there is a term, explain the working under credit creation or explain the mechanism under credit creation. You need to show this table. You then move on with the assumption. You explain how these 2-3 rounds go. You must show some dots here that this doesn't cease after 4 rounds. It keeps on going after this as well. And it's mandatory to give the closure of this table with the help of these 3 last column totals, right? And then you show the calculations of credit creation, how much times it's going to be, and what are the total deposits. You do segregate out of these total deposits what are the primary and secondary deposits, right? This simply and clearly shows there is a relationship, that is inverse relationship, that credit creation is just the inversely proportion of the reserve requirement. You can see it very clearly that if we just take credit creation for the case of 10% of reserve requirement, so credit creation would be 10 times, that is 10. But if credit creation is to be checked when the reserves to be taken are 20%, so this becomes 100 by 20, that's equal to 5. So we have clearly seen there is sometimes a question asked in your boards that how would you show that credit creation is inversely proportional to reserve requirement. In that case, you have to give such 2-3 cases to show that when the credit creation capacity is 10, the reserves were 10. And when reserves were increased to 20, the credit creation capacity reduced to 5. In this way, you can showcase the inverse relationship of this as well. So, over for now. I hope the topic is clearly understood by all of you. We'll continue the learning of banking in the next video. Have a good day. God bless.